The markets are still going pretty crazy in the long-term care area, and I'm happy to be here today with Laca Wong-Hammond. She's managing director at Duff and Phelps. Laca, you made the switch from Raymond James to Duff and Phelps a few months ago. What's your focus at D&P going to be in the long-term care side of the business?
Absolutely. Thanks, Steve, for your time, and I appreciate this conversation. Duff and Phelps, what drew me to them is that Duff and Phelps is a well-known, long-established firm, powerhouse in the corporate finance and valuation business, founded in 1932. In 2013, management and a consortium of private equity funds, including the Carlyle Group, took the company private. Over the years, it's really grown, deepening its services offered in its industry groups, including consumer, energy, technology, industrials, real estate, and healthcare. For me, it felt very synergistic to move my healthcare real estate practice over to Duff and Phelps, taking advantage of this deep industry expertise. The services we offer within my practice include buy-side or sell-side advisory on businesses, its real estate, capital finance, debt and equity, and joint venture formation. We start at the strategic level first, soup to nuts on transaction advisory, all the way from due diligence to closing. Within my service line, we also cover the other spectrum of care, including hospitals, physician practices, and other end users of real estate, including the REITs and developers. In this guise of value-based healthcare, they are becoming great partners with long-term care operators. So the synergies are very deep, with 50-plus healthcare experts in the firm and 80-plus in real estate.
Are your marching orders at Duff and Phelps going to be to kind of work on the long-term care side of the business and beef that up?
I am certainly focusing a large part of my efforts there. As you know, my clientele is broader than just long-term care. We also cover hospitals, physician practice, and other users and occupants of real estate. So they run the entire gamut of healthcare real estate.
Mm-hmm.
My services are very complementary to the larger healthcare M&A practice, since we cover all the healthcare subsectors within this corporate finance function.
Right. And how are you splitting your time between the M&A side and financing side? Are you focused on more on one or the other?
Sure, there's actually demand on both sides. We actually close a number of transactions on the sell side within healthcare. Within my specific healthcare real estate practice, we're actually bringing to market a couple of M&A transactions in the first quarter of next year, so stay tuned. We get a lot of calls on the financing front as well. The capital providers are still very cautious in their underwriting of the borrowers. So depending on the risk appetite and the objectives of our clients, we may or may not take on an assignment unless we know that their objectives are what current market offerings are copacetic with. Then we would structure and customize a financing solution for them, both on the debt and or equity front.
And what are you advising clients? Interest rates, as we all know, are still so low. They're low for fixed. They're really low for floating. Are you advising clients to go fixed now or stay and take advantage of the low floating rates?
Sure. I think a financing structure really has to mesh with a company and a client's objectives in the longer term. Oftentimes, there's an example I love using because it was a recent situation where our client had thought of levering up during the construction phase of a project, and they didn't really think about long-term gains harvesting. What happened was they created a structure where the leverage was very onerous, creating a high prepayment penalty if one was to pay off the financing early on, which is what was required in a sell-side situation. And instead of including an advisor on the front end to better structure this optionality, prepay optionality, they ended up netting out less profits than could have been otherwise. So, in that specific situation, they issued fixed, and it didn't matter the rate necessarily, but the structure of the financing was so onerous on the early prepay side that if an advisor was involved earlier on to help structure this optionality, they could have gotten a lot more profit.
Right.
So we're seeing appetite in the market on both a fixed and floating basis, but it really depends on what a client's objectives are.
What makes it most sense? Now, everyone's talking about this increased presence of foreign capital coming into the seniors housing market. What do you see out there?
Sure. Specifically, actually, this comes very timely. There's interest abroad from Europe, from Asia, and especially in the Middle East. Middle Eastern investors, especially pension funds and insurance companies, are particularly interested in U.S. real estate. This is not just for long-term care, but also for other property types, including hospitality, residential, office, industrial, and student housing. On the debt front, what we find really interesting is that these pension insurance companies are particularly interested in this medium-term vehicle, anywhere from 3 to 7 years, say, and they don't mind buying bonds at variable rate or fixed. And what's most interesting for our client base and your audience is that actually greenfield projects, if pooled into a portfolio of stabilized projects, because both to be constructed and stabilized projects are of interest to this investor base, a to be constructed project could utilize these bonds to replace the mezzanine and equity tranche of the capital stack. So essentially, a construction project could be 100% financed so long as the portfolio overall leverage does not exceed 75%. On a fixed rate basis, between 3 and 7 years, this kind of debt vehicle offers rates in under 5% or under 6% in current capital markets conditions. So covenants are very flexible. It's unsecured corporate debt, and this market is very, very interested in U.S. real estate, including long-term care.
How about the M&A side? Are the Middle Eastern and foreign investors coming in much on the looking at acquisitions as opposed to just financings?
Absolutely, and they're looking at more portfolios than single assets because their equity checks need to be in excess of 75 million or such. So as you can see, then a 150 to 200 million dollar portfolio really grabs the attention of these Middle Eastern investors, for instance. And they understand the healthcare real estate market fairly well. They understand there's reimbursement pressures. We're facing federal and state budgetary pressures. So they will underwrite that risk different than if an operator was more exposed to private pay, for instance.
Okay. And when they are investing in the real estate as opposed to lending, are they coming in direct, or are they usually teaming up with a local private equity partner?
I've seen it done both ways. Some investors will come in direct because they've already created a relationship with a U.S.-based advisor, but the investments are directly made 100% from the capital abroad. And more often than not, they will enjoy a relationship with a minority joint venture partner that is based and exposed in the U.S. In either case, however, management is outsourced to a local partner in the U.S. So if an asset was in Washington, D.C., they like a local property manager or an operator to be their eyes and ears and boots on the ground.
Yeah, which obviously makes a lot of sense. So what's your prognosis for 2015? Are we going to basically see a repeat of 2014 in deal activity and more capital coming into the market?
I think the dynamics are very strong for both sellers and buyers. For sellers, it's really a great market because cost of capital continues to be very, very low. Just think about the one financing example we just spoke about. Sellers are, as a result, enabling themselves to enjoy unprecedented valuations across the spectrum of long-term care. For buyers, there's so many new options for financing, not just traditional bank debt, agency debt, or capital from U.S.-based equity sources. So in both schematics, this creates unprecedented, very strong valuations in all of real estate, especially healthcare. The U.S. healthcare market is still viewed as a very stable, high-growth sector, benefiting from demographic tailwinds. So I really think 2015 holds great prospects.
Well, hopefully some of your clients can tap your Middle Eastern pension fund financing. So we'll see what happens next year. Well, keep us posted on your deals as you start closing them next year, and good luck at Duff Phelps.
Thank you so much. Happy holidays.
All right, same to you.